February 14th, 2025. I'm making the review on Saturday morning. The first thing I wanted to note was the fact that this is the open of the day, and the day was a trading range day. We closed around the open of the day. And it's pretty common to close around the open of the day or the midpoint of the day on a trading range day. I assume the midpoint of the day was essentially very, very near the open of the day. It's not a surprise that the open of the day and the midpoint of the day are near each other because on trading range days, the market tends to oscillate around that point in the middle third of the range. This was actually the smallest day we've had since December 2nd of 2024. So basically in a few months, this was the smallest range we had. And something you have to keep in mind coming into the day is look at this rally from yesterday. Let's just include the first 7 bars as well, just for the point I'm trying to make. Do you think that we're going to get a large sell-off after this many bull bars, right? After all of these bull bars, and basically, we've gone below 1 or 2, but basically you've had 2 bear bars on the 15-minute chart in the past, 10 to 12 bars. So do you think that we're going to get some sort of really large bear trend, some sort of really large sell-off today? No, probably not. The best the bears can probably hope for is a 50% pullback, and they got pretty close. It was in the ballpark of 50%. But when you have a bull trend on the prior day, the odds are, I believe the odds from Al's book, 25% chance of a follow through bull trend day and 75% chance of 2 hours of sideways to down trading. I used to take that the wrong way. I used to start looking for shorts because I would assume it just means, sideways to down, we're probably going to go a little bit down. But you have to keep in mind it's going to be mostly sideways. So when you have a bull trend day, the next day is probably going to be a lot of sideways trading, simply because the bulls are exhausted, but the bears are not strong enough. So that usually is going to lead to some sort of trading range day. I hope that makes sense. 7 and 8 probably might need a second leg, but buying closes is not the most effective strategy when you're this deep into a bull trend. Bar started on bar 54 yesterday. You're 38, 39 bars into a bull trend. So buying high closes is probably not the move. In general, if you're buying closes, you want to be buying closes in early legs. You want to be buying closes in leg 1, going for leg 2. Something like 41 and 42 is a good example. Or selling the close of 22 maybe is a reasonable thing to do. But you want to be buying closes and selling closes in early legs. You don't want to be buying closes in late legs and at the end of bull trends. That's not a very good idea. Bars 9 and 10, consecutive bear bars, good for the bears. We're probably going to get a second leg down from 9 and 10, and we might get some sort of second leg up from 7 and 8. But really, when both sides need a second leg, the important thing to keep in mind is that we're probably in a state of confusion and probably in a trading range. The move down to bar 15 from 9, does this look like bear trend price action? You've seen enough bear trends in your life, I'm sure. And if, go scroll back to the last one or go find an example of one. Does this look like it's going to be a bear trend? No, it really doesn't look like it's going to be a bear trend. However, it's a tight enough channel down that it should get a second leg. I keep going to the 15-minute chart just to demonstrate the example, but it's consecutive bear bars, right? It should get a second leg sideways to down. So as good as it looks on 16 and 17 that we're rallying and we might go a little bit higher, it really might not be all that great. I think the highest the bulls can hope for is the bar 8 close or the bar 8 high, because this should be converting into a trading range after such a long bull trend. 21, 22, those are good bear bars that's going to get a second leg. You can definitely sell the close of 22, but you have to be willing to sit through a pullback. Having a good expectation is really important in trading, because if you're buying the close of 8 and 9, you're sitting through a pullback, and you're scaling in, that's probably a reasonable thing to do. But the problem with buying and selling closes is what people will do is there's 2 optimal ways to manage these types of trades, and there's two bad ways to manage them. And the problem is too many people manage them in the 2 bad ways. If you're buying the close of 8, we'll use 30 for example. Actually, this is probably a better example. So what a lot of people see when they see 29 and 30 is they see consecutive bull bars, and they think about Al's book when he says that we should go higher when we get consecutive bull bars. And they buy the close and they put a stop below and they get stopped out, and they're confused as to why they got stopped out. Well, first off, 21 and 22 is a lot stronger than 29 and 30. That's something you need to keep in mind. Secondly, look at this move. What is it? It's 3 pushes up. 24, pullback. 27, pullback. 30. So 1, pullback, 2, pullback, 3. This is 3 legs up. And so if you're buying the close of 30, you're buying a third leg, and buying closes in the third leg is not a good idea. So one of the ways you absolutely cannot manage this trade is by buying the close of 30 and putting a stop below 29 and letting it get run. That's a losing. You're going to lose money if you do that. The other thing you can't really do, you can do it. It's not good though. It's not good management to buy the close of 30 and just get out below 31. The reason it's not good management is because you're losing more than you need to. The two good ways to manage this type of trade are either, you're either really quick or really slow. So you can buy the close of 30 and you give the trade 90 seconds. You're buying a third leg. That's the thing. The earlier you're buying, if you're buying here at 39.40, 40.41, you're buying a first leg. So you don't really care if it's going sideways because it's a leg one and it's going to get a leg two. But if you're buying the close of 30, you're buying a leg three. So if you're buying a late leg, you need to be quick to get out. I don't really want to sit through a pullback, especially considering the fact that 21 through 23 is stronger than 29 and 30. So if you're buying this close, you give it the trade, I don't know, whatever it is, 1 minute, 2 minutes, right? 2.5 minutes. And if it's not skyrocketing, if it's not going straight up, then you just get out. And I'm willing to bet, I haven't looked. If you look at a 1 minute chart, at some point it gave traders a chance to get out near break even. So let me get the buy to close price. Hold on. Let me just so the open of this bar is 6137.5. That's the price you would have bought at had you just hit buy the market, on that bar. Okay, 6137.5 is right here. And look, this is a 1 minute chart. So the bear bar closing near its low is these 5 bars. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. And you can see 2 minutes in, basically stalled. And then 3 minutes in, it went back up to test that close. And it went back up and tested that 6137.5. And then the bulls got out. So the one way you can manage it is basically give the trade a couple of minutes and then get out as close to break even as possible. And those traders are able to not lose money on this trade. The other way you can do it, this is much more difficult but the other way you can do it is use a really wide stop, maybe, I don't know, very far, maybe a measured move down, and look to add on as you go lower. That's the other way you could do it. Basically buy the close of 30, and your bet, if you're doing that, is that this is not a bear trend day. You know that this rally is pretty strong, this rally is pretty strong, and yesterday's rally is pretty strong. So you could buy the close of 30 and expect that we might have to test somewhere up into these closes, and we'll probably go above 30 at some point again today. You can do that, but the thing is, when you're looking at bar 36, right? This is the problem with this. Everyone looks at this and says, I'm going to start scaling in. That's a great idea. But it's really hard to be confident in your read if you're not an experienced trader when you're staring at this. When you bought the close of 30, your plan is to scale in lower. And now it's time to scale in lower, bar 36. But you've had 5 of the past 6 bars are bear bars. And it's starting to get, it's closer to your stop than you probably ever anticipated it being. So, it's really hard to scale into these because the problem is sometimes they will go against you and you'll lose a lot of money. Especially if you're just starting out trying to do that, you're probably going to lose a lot of money. So I would encourage you, if you're buying in third or fourth legs, to be very, very quick to just exit the trade. If it doesn't, go in your direction quickly in the first minute or two, maybe 2 to 3 minutes. And if you're buying in leg one, you can be a lot more relaxed with your management and just expect that you're going to get a second leg up. And obviously, second leg ends up being similar size to the first leg and rallies back up to the magnet above the bar 20 close. So we have 3 legs up. 31 is a credible swing short because you have 3 legs up. And what you're betting on, your expectation if you're selling below 31 is that the bulls who bought the close of 30 are trapped. You're betting that 21 through 23 is going to get a second leg down. And so that we should go at least 1 tick below the bar 23 low. And if you're selling, you're risking 2.5 points. Well, you'd be 1 tick below there. Like 3 points essentially, and you're trying to make 6, or you could call it 6.25. So you have roughly 2 to 1 selling below 31 and maybe a 50-50 chance at, making money if you sell below 31, trying to get to the bar 23 low. And so a lot of traders take the trade, or you could sell the close of 32. If you're selling the close of 32, you're simply betting on the second leg down, but that's a credible thing to do as well. You could, I don't know if I'd sell the close of 36 because it's a second leg, and that 31 and 32 and 33 is leg 1, 35 and 36 is leg 2, and then obviously 38, 39 is going to be leg 3. And after 3 legs, and you're getting a doji bar, it's hard to hold short is the problem, because you can give back all of your profit from the last 6 bars in 1 bar. So you have to just be, again, it comes down to being quick to get out. If you're selling below 38, you're selling, a third leg. It's kind of the same premise of if you're selling below 38, you need the bar to look like 32. You need a giant bear bar closing near its low. And instead you get basically a doji bar. So those traders are going to exit causing 40 and 41 are the best trades of the day. That's the only trade I took today. So during 48, I bought the 40 high. I was trying to buy during 46, but it didn't end up filling me. But about the 40 high during 48, it's fine to just buy the close of 42. You don't have to wait on a limit order. You can also buy the close of 41. That's completely fine as well. So buy these closes and expect the second leg up. Maybe try to get to the bar 20 low. Possible stop for the bulls, or the bar 20 high. But usually the low is a safer bet, obviously, just because it's closer, so it has a higher probability. But the limit order traders were more interested in buying below bars on a day like this. And then we get 2 legs up, like I said, small third leg, bar 57. And then 4 straight bear bars. This was probably going at least a little bit lower. So this would be the only real 4-bar micro channel trade of the day if you wanted to. I mean, it would have made money, but then we basically went sideways. So as far as trades on the day, you probably could have bought above 7, but it's just early, so tough. Probably 16 makes sense. You got to get up below 21. You could sell below 21 or the close to 22, and then sell below 31, 32. I already talked about 29 and 30. So, and you could buy above 40 or 41. And I probably would just leave it at that. I mean, the rest of the stuff, it wasn't a great day for stop orders. Some days are like this. And this is the problem with the whole leg 1, leg 2, stuff in trading ranges. It's less effective. So that's something you do have to keep in mind. All right, the daily chart, let me do that real quick. So it's actually pretty important that we got a bull close on here because it's follow through for the bulls. So a big bull bar gets some follow through. But again, if you bought up here, you might be buying a late leg. So if you're buying this close, are you enthusiastic about your follow through? No, probably not. Doesn't mean we won't go higher. We are going to go higher. It just means we might have to pull back and maybe test the 212 high first. 6,100, that whole area might have to be an area we test before we go higher. So that's just something to keep in mind. We are at the top of the trading range, and we've been in a very tight trading range. Really, it's just a triangle. So we could go sideways for a few more days before we get a breakout attempt. The weekly chart, consecutive bull bars. So 4 of the last 5 weeks have been bull weeks, and 3 of them closing near their highs. I do think we're going higher, but that's not exactly a bold prediction as far as the weekly chart goes, because it's almost always going higher. Again, it does pull back at times. There are obviously recessions and deep pullbacks, but it's just better to assume it's going to go higher. And when it becomes obvious that it's going lower, then you can change your mentality. But for the most part, I just think we're going to end up going higher right now. All right, that's going to be it for this video.